Hello, I'm Sam Stovall, U.S. Equity Strategist for S&P Capital IQ. In this week's Sector Watch, found on www.getmarketscope.com, I discussed market and sector correlations with the U.S. dollar. The value of the U.S. dollar index is at its highest level since June of 2010. It's up nearly 6% since the start of the year and by more than 16% since its previous low in April of 2011. As a result, the strength in U.S. stocks, as well as the weakness in foreign equities, gold, and oil, has been blamed on the dollar. But should they? Since 1987, using average rolling 12-month correlations, gold and oil demonstrated the highest negative coefficients. In addition, their frequencies of negative monthly observations were each at 70% or higher. U.S. stock prices, however, have been affected by a variety of crosscurrents, so it should come as no surprise that the S&P 500 showed little average correlation with the U.S. dollar alone, whether looking at rolling 12 or 36-month correlations. In addition, a majority of sectors in the S&P 500 also sported inconclusive correlations. At the sub-industry level, however, there were several groups that either bopped alongside the buck, such as airlines, or gracefully gyrated in reverse of the greenback, like diversified metals and mining. However, S&P Capital IQ believes that the S&P 500 and a majority of its sectors and sub-industries will continue to benefit from foreign investors' attraction to our recovering economy, despite S&P Economics' forecast for the dollar-euro to strengthen further from the current 128 to 125 by year-end and average 120 during 2015. I'm Sam Stovall, and I'll talk with you again next week.